All right, how you doing?
Doing all right. It's good to be here.
Yeah.
I always love Breakpoint. It's, I think, the best produced conference in crypto.
Yeah.
Would you agree with that, guys? Do you think so? They crush it.
For sure. So yeah, it's great to talk to you. And I'm just to give you a sense, there are a lot of people out who are going to be watching this later who are from traditional institutions, don't have your knowledge base. And so I think just starting from a high level, the best thing we can do is to probably point out some of the biggest differences between traditional venture and the work you're doing at Multicoin when you make investments in the Solana ecosystem.
Yeah, actually, this was one of the first posts we ever wrote. When we started Multicoin in 2017, I wrote this post called Venture Economics with Public Market Liquidity. And I think that's the biggest thing that's different in crypto compared to traditional venture. Because in traditional venture, you put in the investment, it just kind of sits marked at whatever the last round was. And underneath the surface, like there's all this stuff happening. Right? The company's chances of success are increasing or decreasing. They lost a key person, or they hired someone awesome, or they won this key contract. But you don't have liquidity, and the price is just marked at the same level, despite all of this crazy stuff happening under the surface. And what's exciting about crypto is things go public way earlier in their life cycle. You don't need to be, a multi-billion-dollar company or protocol in order to go public. And what that means is, as an investor, you get to reassess your views. You get to see how is the market pricing this thesis or this asset, and you can act on it. If the market is underpricing it, you can add more. You don't have to wait for them to raise a new round. If the market is overpricing it, you can actually sell some right now, even if the whole thing hasn't realized yet, because maybe the price is a little bit too high. So I think it's a very different style of investing. It's almost a crossover between venture and public markets.
Yeah.
Because it's not traditional public markets investing, because you're not investing in some of these protocols and they don't have the stability of an Amazon or
That's right.
Right? Like you're not necessarily doing a big discounted cash flow analysis and understanding all the different business lines and then saying, this is going to grow at 2%, 3%, so on.
Right.
So it's kind of a combination of those two. It's like a venture investing mindset.
Right.
But with the ability to manage your emotions and manage your positions that you need in public markets.
Yeah, so I guess of course there's forecasts, there's management guidance that comes out when you have a bigger stable company and you can see if somebody's hit their numbers or not. You have the scrutiny of a quarterly reporting cycle. So when you have something that's much earlier in its adoption and has more volatility, what are you supposed to do from the standpoint of valuation? What frameworks are you using? What's helpful? What's actually kind of a red herring that takes you the wrong way? How should we think about that?
It's different for different types of assets, right? You have to develop novel valuation frameworks. For example, I gave a presentation in 2022 at the Multicoin Summit. The video is on our website at multicoin.capital on how to value L1s. So how do you value Solana, for example? Right? And I think it's a sum of the parts valuation with 3 components. There is a cash flow portion of it around discounted cash flow of MEV, which is cash flow to the chain, in a sense.
Right, so basically profit from transaction ordering.
Exactly,
okay.
Yeah. And then there's a commodity aspect of people need this in order to pay for transactions. It's almost like the gas concept. Why is oil valuable? Because you can burn it for gas. And then there was kind of this squishy store of value element of people own this because it's non-dilutable by governments and we're worried about fiat debasement and things like that. And it's kind of a sum of the parts thing, right? But then you look at a DeFi protocol and that same valuation framework doesn't apply anymore.
Right.
Now you're looking at, okay, what's the cash flow of this protocol and how do I expect that to change in the future? And things are actually really different in crypto when you think about those types of valuations than in traditional investing, because everything is open source and everything is permissionless. And so, to give you an idea of how we think about DeFi valuations, what we're really thinking about is how much risk does this protocol manage? One of the best theses that we developed and also on our blog is called Protocols Don't Collect Fees, DAOs Manage Risk. And this specifically lays out how we think about DeFi valuations. Because what I think you're going to see is a lot of margin compression on DeFi protocols, because it's open source and permissionless, like I mentioned. But there is still a potential for value capture if you manage some risk in the protocol. And for both of these topics, I'm much more eloquent in writing, so check out the actual post. I'm just giving you the super high level right now.
Yeah, well, I guess then maybe another way to get at this, because as you say, you have to change frameworks depending on where something is in terms of size and where it sits, and if it does have a monopoly over something or it is open source. I guess then how should we think about the biggest risks that you are encountering in these protocols? I mean, is it, normally with the old equity world, you just look at the team, you look at if there is the usual 5 forces, the Porter framework, all that stuff. What does that look like here? It feels like there's memetics and narrative, and there's a sense of a timing of when you launch a protocol, and like it's so sensitive to the macros we were hearing from Raul. So do you find that you do have a risk framework that you continually use, or how does that work at Multicoin?
No, nothing is continuous. Like it's just like very much case by case, because these things are so different in how they get valued. Right? Valuing a DeFi network is going to be very different than valuing an L1, is going to be very different than valuing a DPIN type investment like a Helium or something. Is going to be quite different from valuing an infrastructure layer, whether it's like a company, that does like RPC or ZKTLS or any of these other middleware infrastructure products. So I think you have to truly understand each of those specific verticals and then apply the appropriate framework to that vertical. And that's actually what I like from a selfish perspective and as a professional manager love about crypto is, as a passive investor, you can go buy Bitcoin or something and like use the ETF or buy Bitcoin directly. Simple, you don't really need to pay someone to do that. But the opportunities for alpha are significant if you actually understand and deeply live in the world of these different types of protocols. You're coming up with your risk frameworks, you're coming up with your valuation frameworks. And that's not something that like a generalist investor is going to be able to do. You're just looking at too much stuff. You need to be focused, you need to be specialized.
Yeah.
And I don't think a generalist investor can compete at that level just because they're spread too thin.
Yeah, well, and we were saying earlier about how it's a barbell. You have your highly liquid passive positions that weight one side, and then active management is really something you should outsource, because that expertise is totally specific and full-time, as you show at Multicoin. So I think the other big question that a traditional institution would have is really about this concept of like a token cap table versus an equity cap table. So at least from first blush, right, it seems like there's a big conflict. How can you have both? How can you coordinate behavior when value might be going to equity on the one hand, but then again, there's a whole utility side and a liquid token market? Should one collapse? Should one never be used? Should both be used? It's something that I think is a work in progress and is evolving with the space. But you have a seat at the forefront of all of this. And so how have your views changed with regards to that dual structure?
Yeah, this is something I've been thinking a lot about, actually, because there's a lot of historical path dependency to how this works. And the biggest problem this industry had for a long time was Gary Gensler and the SEC and their vindictive approach to anything crypto-related. And so what we saw was people having to twist themselves into legal pretzels to be like, this is the utility token, it just does governance, there's no claim on anything, and then over here is like the equity that actually does have a claim, and we're going to sell both to venture investors, but then to the public market, we're just going to sell this piece here because like that's what we can do.
Yeah.
And it was just convoluted and quite frankly like inefficient and created all these problems. And now I think the world that we're moving towards is actually these things merge. And it's this concept I'm calling equity 2.0, Like, what does equity actually look like in an internet-native world? Equity in the pre-internet world, in the printing press world, or the industrial age world, was just ownership. It's just ownership in a company and then some right to elect directors, and that's it. Super simple. But now we have all this programmability that has become available. You can do things like lock up your tokens. You can do things like use them in certain derivatives positions or contracts that weren't previously accessible or possible. You can prove how long you've owned the token. That wasn't possible with equities. Like, I can't prove to you that I've owned Apple shares for 10 years. How do I actually prove that? And so I think with Equity 2.0, what we're going to see is this merger of the best practices that we've seen from tokens, which is internationally available, always liquid, always trading, ability to program them, most importantly, so you can do things more sophisticated than just own it, and ability to prove ownership and cryptographically prove certain attributes about your position. I think you're going to take those best practices and you're going to merge them with equity protections of, I actually own the cash flows of this thing. I don't just have some vague claim to them, right? I'll give you an example of this. Binance Equity and BNB, right? Like, Binance is one of the most profitable companies on the face of this earth, right? BNB has a tangential, maybe sort of kind of claim to that cash flow. Like, we'll theoretically burn based on kind of sort of the revenue that we make, all right? Like, really, those two things should be the same. The reason that they're not is regulatory reasons from a path-dependent history perspective.
Yeah.
But what I expect we're going to go to, if Binance was started today,
Yeah.
BNB would be equity. And it would be a combination of the two things.
So and maybe to even give another example, that something from the traditional world that's not crypto specific for the institutions. What would this blend, this Equity 2.0 look like?
So let me give you a really simple example. It's something I've been thinking about. I imagine everyone's familiar with Costco, the membership shopping store, right? Like, you need a membership. What if the membership was you had to buy one share of Costco every year in order to be a member? Like, that's pretty interesting, actually. Now, what you're doing is you're converting your customers into your shareholders. Mm-hmm. You're going to end up with more loyal customers because they actually own your shares, and they can prove that they own them. And you're lowering your cost of capital by doing this, because now you have all these people, like Costco. If there's, say, 50 million memberships, and they can charge you, they can say you have to buy $100 worth of my shares every year, lock them up for 10 years in order to be a member. That's $5 billion a year of buying demand that they just introduced to their stock, for example, right? That's actually pretty substantial. So that's an example from the traditional world that I think is pretty easy to understand. I think it's going to be more sophisticated than that. I think the companies that implement this are going to be earlier stage companies. It's not going to be Fortune 500 at first, too risky for them. But I do expect in, say 10, 15 years that even the big Fortune 500 companies will be moving towards a Equity 2.0 model. Maybe it's you get a discount. You've owned my shares for 5 years, so you get 5% off. Things like that. Like, there's a lot of new design space that opens up with programmability of assets and verifiability of those assets.
Amazing. Well, these sessions are brief, but I think this is one of the most exciting things too. That will change how cap tables and the coordination of behavior with owners change over time. So with that, thank you so much, Tushar. Yeah,
absolutely.
We could all give him a round of applause.